Welcome everyone to this week's edition of the Commercial Real Estate 101 Meetup Group. Thanks again for all of you guys who are tuning in. For those of you guys who are tuning in for the first time, we actually started this group back in mid to early 2020 in response to COVID. And ever since then, we've just been inviting speakers from all across the country to discuss a variety of different topics that pertain to commercial real estate. And today we have a phenomenal guest. I'm actually really excited to talk about this. I focus primarily on the retail space here in Louisville, Kentucky, and Alex has been in the space and really operating not only just in retail. I mean, you guys have products in the industrial space, office, but I've looked at your guys' portfolio and you guys do have a heavy presence in the retail sector. So I'm really excited to kind of dive in and learn a little bit more about your background and then maybe some of your insights regarding the evolution of retail real estate as well. So welcome.
Thank you. Happy to be here.
Oh, absolutely. So one thing we typically like to do when we first get started is we like to learn a little bit more about the person that's across the table from us. So if you don't mind kind of sharing your backstory, I think that'd be awesome.
Sure. So I started Capstone Advisors 27 years ago, and the company's gone through a number of different evolutions over the years, but during the entire 27 years, the very first asset class that we bought was retail. We've done all sorts of other stuff. As you mentioned, we've invested in office and industrial. We've done a lot of land development, land entitlement, home building investments. So it's a pretty diversified platform, and we've invested, I think, in 14 different states. So, from California to Florida to, everything in between, Colorado. Right now, our portfolio is primarily located in Southern California. It's a big footprint of ours, and then we have a decent sized footprint in Arizona and Phoenix specifically, and then the next footprint of ours is over in Virginia, and then we have some scattered properties in other locations. But we're predominantly most of the portfolio though is predominantly multi-tenant retail. And we're a private company and very entrepreneurial, and we do a little bit of ground up development. We do a lot of entitlement, but we do a little bit of ground up development. And the retail that we typically buy, we really love to buy stuff that is sort of in the value add area, that we can buy it and then improve it. We tend not to sell stuff very frequently, so once we fix it, we tend to put it in the portfolio and keep it. But we'll also buy sort of good, solid core plus property as well.
Definitely. That's awesome. Yeah. And I was able to go through your portfolio a little bit to kind of see what product you guys have. And you're right. You have product in Southern California, Arizona. I even saw that you guys have a land in Costa Rica as well,
Yeah.
Which is kind of interesting. I'm assuming, are you guys wanting to do like a hospitality development at that area?
Yeah, that's a hotel and residential big project down there.
That's awesome. Yeah. And yeah, it just goes to show that you can operate in a variety of different environments outside of just your local regional area. So that's awesome. One thing I'm curious about is what made you decide to get into the commercial space to begin with? Is this something that you've kind of always aspired to, or is this something that, just you just kind of fumbled into?
Yeah. So, when I started, my career, when I started my career in 1991, effectively in real estate, that was the start of the savings and loan industry meltdown. And so when I first got out of graduate school, I spent 3 years doing bankruptcies and workouts and restructurings and big portfolio sales in the savings and loan industry. So I knew I wanted to go into real estate. I just didn't know where. And that's sort of where all the action was when I got out of school. And it was I tell people it was a great place to start and a great time to start is in a downturn. So anybody that's like just getting into the industry right now and things were a little wonky, I think it's really good to see a little bit of distress in the market, or a lot of distress when you're starting your career, to really start to understand that asset values can go up and they can go down as well. Anyways, I did that for a while. Then I traded mortgages for a bit of time after that. And then I was just sort of, and then in 1990, end of 1996 is when I started my company. I was sort of looking at the real estate space sort of in a most broad perspective, everything from, continuing to trade mortgages to portfolio deals, trying to figure out where is the action. And at that point of the cycle, it was really that there was a lot of real estate that had been in hands of portfolio buyers or owners that hadn't really been optimizing the real estate, or the real estate had been capital starved for a long period of time. There was great illiquidity in the marketplace. And, so made a determination, the best entry point at that time was just to go buy the real property. And then, and then under a strategy of buy it, fix it, and sell it. So I was fortunate enough to be able to team up with a big institutional capital platform and go out and start pretty aggressively buying broken property all over the United States, and assembled a team of people to do that here at the company, and have been an owner, operator, developer ever since. We have floated around different aspects of the market. So today we're predominantly the owner operator. But we've been through periods where we were primarily equity partners to other operators and developers, and we've invested in billions of dollars worth of home building ventures in the Western United States. And like I said, we have a fairly active land portfolio, but sort of the core ongoing operation of the company that will always be there is our multi-tenant commercial real estate portfolio. That's sort of our anchor that gives our company stability, and that's predominantly retail.
Definitely. No, for sure. And so, you described, the transition from your work in the early 90s to starting your own company in 96. There's definitely people that are listening to the call that are at that inflection point in their career. They've been, doing this for maybe a few years, 5, 6, 7 years, and they've built up a good book of business. And now they feel a little bit more comfortable with maybe starting their own thing and establishing themselves in a, their own type of, company. I'm kind of curious, what were some of the early struggles that you faced on that, on the establishment of that corporation? And then ultimately, how did you traverse those early years?
Yeah. So, I was very, very fortunate that I, through my prior work experience, I had established really good capital relationships. So I think what was one of the hardest things for people to establish in the beginning is a capital relationship. And I had that in place by the time I went off on my own. So for me at the time, the hardest thing was just getting credibility, right, into the marketplace I'm a very much was an anomaly at the time. I never worked for a company that owned real estate. I didn't have any asset management or property management or leasing. I had no direct ownership experience in commercial real estate. Everything that I had done was either, in mortgage trading, or was in the sort of the more consulting portfolio type work that I had done. So the biggest thing that I had to overcome was just getting people to transact with me and take me seriously for my first transaction. But, and then sort of building that credibility. So literally this is, back in the day of Rolodexes, I was calling, investment sales brokers, and I'm telling them I'm looking to buy something. And I was met with it, understandably so, some amount of skepticism of, like, who are you? And like, what? And so I remember very distinctly, like, I get my first transaction done. We, this is kind of like early, almost like pre-internet days, like I would mail out announcement cards to all the investment sales brokers that were in our database to announce that we'd closed a transaction. Then we'd close another transaction, send out another announcement that we closed another deal. And it was just that flywheel of repeatedly showing that we could close transactions and work closing transactions that changed the mindset. And I remember, this one investment sales broker that had been, pretty, doubtful in the beginning of my discussions. I remember this one day when he called me up and he said, my business plan this year is to close a deal with you. And I was like, great. Now like we have established this credibility. So, and then building a team of people around it. When I started, I was 33 years old, and I had to put a team of people that actually were the nuts and bolts real estate operators and experts on it, because I just had basically a theoretical understanding of it at that point. Yeah, we were able to do that and buy quite a bit of real estate, and kind of all worked out.
It's awesome. Yeah. And I love the idea, like you had mentioned, about, creating credibility, or at least showcasing to the marketplace that you do have the credibility to be able to execute. Because, I would imagine that for the investment sales brokers on the call, like they get calls all the time from people that are looking for opportunities, and, they probably want to focus their attention on those that can execute, and ones that they know that if they put an opportunity in front of them, they either provide feedback as to why it's not going to work, but also if they decide to move forward with that group, that they're able to get to the closing table. So
yeah, it's super important that you take care of the investment sales professionals that you work with. I mean, you don't, we're very thoughtful. We don't want to engage in any transaction that we don't have a very high probability and likelihood that we're actually going to close that deal, like really high. By the time we put an offer on something, we vetted it very extensively. We know we have our capital, we understand the market. We're going to go ahead and transact on this, assuming that nothing radical doesn't show up in due diligence, because not only is it, time and effort and money on our part, but it's also like, we understand, like, we're putting the investment sales broker at risk, right? If they give, go to their client and, suggest that we get the nod on the acquisition, and then we act, arbitrary and don't close on it, I mean, that we're putting their relationship with their client at risk. So it's super important that as a buyer, that you very much protect your reputation on the buy side, and that you do what you say you're going to do.
That's phenomenal advice. And I'm sure there's a lot of people who can take that away as far as, insights pertaining to this podcast. But one thing I'm curious about, and obviously one of the cool things we like to do with these conversations is we like to focus on a particular subject each time we host a guest. And today we wanted to focus on the evolution of retail real estate, because I find retail fascinating. It's just such a constantly evolving industry, and obviously there's different types of retail that people operate in, and everything like that. But one thing I'm kind of curious about is, when you first started in the business back in '96, what type of product were you guys targeting, and why were you guys targeting that, and how has that evolved since then?
Yeah, so when we started, there was, it was a very different market than there has been in the last, in a lot of years. What there was a tremendous amount of distressed assets that were out in the marketplace, that were just broken assets, that were broken because of capital, lack of availability of capital, right? So there was a fair amount of pretty decent retail or real estate assets total that just had been in the hands of capital constrained owners. So, so the trick was, okay, finding the asset and then understanding, okay, this thing's broken, it's got a lot of vacancy. Is it broken because there's something fundamentally wrong with it? Is it out positioned? Is it got, a bunch of obsolescence? Is it bad layout, whatever, right? Or is it broken because it hasn't been properly managed? And it needs new capital to go into it. It needs a refresh. At that time, you could find assets that just prior owners couldn't put tenant improvement money out, right? So if you could put reasonable tenant improvement money out and actually pay the leasing brokers a commission and not jerk them around, you could get some leasing. And we were also at that point, the economy was improving, coming out of a pretty tough period of time. So versus, over the last number of years, where, really, capital availability hasn't been an issue, right? It's been, there's been so much more money into the markets, forgetting about the last 18 months, but before that, there have been no shortage of capital into the market, right? So, finding opportunity was a sort of a different animal.
Definitely. No, I couldn't agree more. And as far as the product itself, has that shifted as far as what you guys have been targeting?
Yeah,
I don't know how, you see a difference between, 1996 and today. Cause I mean, I feel like the retail has definitely been evolving ever since, the
yeah.
advent of, you know,
Yeah. So, yeah, for sure. Like, right, like we try to mitigate big box risk as much as possible. You know, I remember in 2000, really vividly thinking about what this online sales phenomenon was going to do to retail. What is this Amazon thing, and what impacts it's going to have to retail? And it became pretty clear that that online presence was going to have pretty significant impact to retail, but not necessarily all retail. And I think for a long period of time, everybody sort of started to, redline all retail and say retail's bad, it's all going to go online, and we should avoid it. And and I think that whole mindset has definitely changed. I tell people the best thing that's happened to retail's reputation was sort of its performance in the pandemic. For the retail that we own, right? We own open air, grocery anchored primarily, and our tenants are, grocery, they're hair salons, they're gyms, they're the chiropractor, they're the dentist, right? They're all necessity-based retail. They're all stuff you can't get online, right? I tell people everything you're wearing, you're probably not buying at one of our centers, right? But you go to our centers every day, and that can't be replaced by, an online service provider. So there was this period of time, though, that was like pretty attractive period of time to be buying retail, where most institutional capital was just like saying, forget retail, we're afraid of all retail, because they've been, tagged on enclosed malls or big power centers that had been, disrupted by online sales. And we had shied away from that, decades ago, and said that we're not going to buy that type of asset class. We're going to buy the stuff that has lower releasing cost and, much easier to plug in new tenants. And we're going to focus on stuff we feel is more durable.
definitely. No, that's amazing. And I've noticed that in my brokerage business, where you have like the neighborhood centers that are performing extremely well. I mean, like you said, having the dentist or chiropractor or nail salon, bakeries, you see a lot more, restaurants historically, you had a large footprint, maybe, you see the Chili's and some of these larger entities, like the 5,000 square foot footprints, those are beginning to shrink, and you're starting to see them come into strip centers, and obviously you can't replace that. Those are things you cannot replace. And as you mentioned during COVID, I mean, the performance of retail surprisingly was very strong compared to some other property types. Obviously, industrial went through the roof, and I mean, it's very difficult to compete with something like that. But it held its own very well, considering what you would think would have impacted retail to a sizable amount.
Yeah. Our portfolio, like our occupancy is as high as it's ever been, or higher. Our rents have trended up, and frankly, all that stimulus money that got dumped into the economy is, it's still running around, right? And people are shopping with it, right? And it's migrated from when everybody was locked home at home, buying Peloton bikes. Right now, it's migrated into service, right? So it's really helping our tenants, because it's going through, and everybody's out shopping. So that continues to, all that retail continues to perform really well.
Yeah, and you had even alluded to it a little bit, is the retailization of even medical, like medical offices moving into some of these strip centers. Like historically, that necessarily wasn't as common of an occurrence, but nowadays, like you see your optometrist is in a strip center, you see a physical therapist, you start seeing some other medical uses that can move in as well. So again, and all these cannot be replicated from an online medium. So it's very interesting.
Yeah, and in retail, I mean, it is a bit of a tricky asset class to run, right? I mean, it has its own. You've got to be very thoughtful when you're a retail owner about who you're putting in your center, and really making sure that they're going to add some additional value to the surrounding neighbors and be, you know, so you can't just like slam anybody into these retail centers. In fact, you can really harm yourself by putting the wrong tenants in. It can be very detrimental to a center. So we have a pretty high criteria level of like who we're going to let into the center. You know, we're very focused on, you know, we want all the communities where we operate to be happy that our center is in their community and they see it as a positive attribute of their community. And, you know, and the other thing that we want is nobody wants to see those tenants be successful more than we want them to be successful, right? So we have a very vested interest that we put tenants in there that are going to perform well and are given the tools that they need to be successful. And if they're successful because they're serving their clients, the local community. So we do spend a lot of time talking about, is this the right tenant for this center, and what else are they going to bring to the tenants and into the community? So, and you know, and then the other thing that we do, which is maybe a little bit different, you know, as a landlord and maybe unique to the asset class, is, you know, we are obviously signing leases with tenants, and, you know, we do like longer term leases. But if we get a tenant in and we're up, you know, we got a good economy going and we've got a tenant that's struggling and they're having trouble paying rent, you know, we don't, you know, we're pretty quick to go to them and say, hey, listen, like, you know, one, let's see if we can do something that, you know, let's talk about your business and how it's going. And, you know, is there some additional resources we can bring to you, or, you know, what are you doing for advertising? What are you doing? You know, like we'll actually meet with them and try to talk through the business with them. But if it's clear that, hey, this is just a concept that's not going to work, or an ownership that's not really going to be able to make this thing go, we're pretty open to talking to them about, hey, let's get an agreement in place and give us the right to go out and find a replacement for your space and let you out of this lease when we can, you know, let us go find a replacement for you. Because my take is, if you're not successful in a good market, you're for sure blowing up in a bad market, right? So, you know, the good market is the time to replace your weak tenants, so that when you do go into a tougher economic period of time, you've got the best tenants possible in your portfolio. And if you really think about, you know, what we all just went through with COVID, right? I mean, COVID was a pretty big shakeup period. I mean, it was a very stressful period of time when everybody was locked down. And, you know, the way I sort of look at the tenants that we lost out of our portfolio during the COVID period was, I think it was just an acceleration of tenants that were going to go out of business over some period of time anyways, right? And maybe accelerating them a couple of years. But that was in a lot of ways, that was sort of like a cleansing of sort of tenants or in uses that probably needed to get moved out of the retail world anyways. And there was a lot of really successful tenants that went in and backfilled those spaces. So we sort of feel like the tenant mix that we have today is the best tenant mix that we've probably ever had.
That's amazing. No, and so out of curiosity, you know, if you could share maybe an example of one of the projects that you guys have done recently or in the past that, you know, kind of profiles your approach to the process. So maybe you identified a center, and, you know, maybe it's in a California center that you guys own where you found it, and what was the existing tenant mix, and how did you reposition it so that now you guys have a very high performing property?
Yeah. So, well, I mean, so we bought a small center in Encinitas, California, on the main retail corridor, which is El Camino Real. It is the main for, you know, very high demographics areas, great households, great, you know, employment area. It's a great part of San Diego County, and we were able to buy the ugliest retail center on the street. So, you know, and we looked at it and we also, this is sort of a little bit outside of what we would normally buy too. is it had a second story retail, and you always go, oh my gosh, second story retail, who wants that? But the beautiful part of this center was it wasn't perpendicular to the road, it was parallel to the road. So all the shop space had great visibility to the street, and the first floor is accessed in the front, and the second floor you drive around behind it to a parking lot. So you still park right in front of it and just walk in. There's no stairs. And we bought that center, and we did a very extensive renovation to it. We tore the entire facade off of both the front and the back and the side. So, you know, it was a true, it wasn't a four-sided extensive renovation, but it was an extensive three-side renovation, and the front side being 2 stories. And what we're able to do is dramatically, we opened up some really heavy columns that were in the front. We shrank the columns down to get better visibility from the street into the tenant spaces. And the other thing that we did was we took off some really outdated roof treatments and we're able to open up and make much higher sign bandage, so that the tenant signs could really be seen much better from the road. And, you know, and then we hired a great architect and made it what I think is truly now one of the nicest, the best looking retail centers. And then, you know, once we do that, then you got to go through and, you know, it's always our hope that the tenants that are in there, that we come to them and say, listen, we're going to spend all this money. We're going to make this place look great. We put all new signage out. We got rid of the pylon sign. We put brand new signage on the property. It reads great from the street. And then, you know, we go to the tenants and we say, listen, you know, we gave you a great new home to be housed at, and you're hoping that those tenants are going to pick up the additional sales to be able to allow you to push rents where you need the rents to be. So it went from being, you know, like very under market rents in place because it was a very unattractive property, to being now we're at market levels. And a lot of the tenants, you know, are very appreciative of that. And they're like, great, like my traffic is up dramatically. And when it's time to renew, we can move them to new market rents because their sales are up. You know, that's the goal, right? And unfortunately, you can't, not everyone's gonna step up to the new opportunity, and then you got to do a little bit of replacement. But like that's a classic value add investment for us, and we love when we can get our hands on properties like that.
Yeah, so you start with a foundation of understanding the market clearly and saying this is the demographics in this area support, you know, potentially whatever type of retail you think would be appropriate for that particular center, and then visibility, accessibility for the actual center itself, and then from there finding and executing on the opportunity. And the business plan itself is to renovate and update and bring in, you know, keep existing tenants if possible, but otherwise, if they can't step up the plate because they just can't support it with their sales, then relocating and trying to see if you could find new tenants.
Yeah, and you got to bring in people that can take advantage of the new environment that you built for them. And, you know, so that's a new deal, but, you know, we're also very focused on our existing portfolio and making sure we're reinvesting in our existing portfolio. We own another property in San Diego. We've owned it for, you know, probably going on 10 years now. And it's time that we go ahead and renovate that center. It was an older property when we bought it. We did a light renovation on it and took it from a fairly distressed state to today 100% occupancy, and we've been upgrading the tenant mix. And now we're the area around it has really matured and became much more dense. There's been a lot of new high density multifamily going in around it, which has been great for the center. And now we're looking at, okay, it's time to go in and do a heavier lift on this one, and make sure that we're always keeping our properties so that they're, you know, good looking and relevant in the marketplace. The other thing we've been doing with a lot of our centers is we get onto the bandwagon pretty early with bringing electric charging to the stations. And in the beginning, the pitch from some of the the charging stations were, we're an amenity, you need to pay for us to come in, and this is, but we'll bring traffic. That has changed now, where a lot of the charging companies will pay a reasonable rent for the parking lot. And in the beginning, when I would drive by and I would see other centers that would have charging stations, I was always sort of confused, like, okay, like they put this charging station, but it could not be more inconvenient from where the charging stations are to where the tenants are. A lot of times it was like in the ancillary parking way off in the side or in the back where the charging stations would be. We took a different approach. We said, hey, listen, especially with the rapid high-speed charging so we're putting fast charging in, right? So, and if you've got an electric car, most of the time when you're fast charging, you're only there for 10 minutes. You're not there for extended periods of time, but it's long enough where you probably want to get out of the car and do something. So we're putting that charging where it's feeding our quick service tenants, so that there's it's a nice loop that, one, we're getting good income off the parking lot for a portion of it. We're being thoughtful not to overdo it, right? But two, it's bringing new shoppers into the center, which is also positive, and it's also driving traffic to the quick serve guys.
That's amazing. Yeah, and being deliberate and strategic about that is something that's quite impactful. So that's awesome that you've been able to accomplish that at various different centers that you guys have. So one last question before we up to Q&A. We have a good amount of people on the call, and I'm sure a lot of them are going to be having questions pertaining to the topic of discussion. So where do you see the future of retail going? Obviously, it's evolved quite a bit since you've been in the business, but as far as trends are concerned, where do you think that we're heading going forward?
Yeah, I think there's still a lot of, the one thing about retail always evolves, right? It's like, the need of retail. That's why it's sort of really fun, and that's why it can be a difficult asset class as well, is because things continually evolve and change. Like one of the things we were talking about before you hit the record button was the sort of large format sit down restaurants. I think those continue to have pressure, and it's most of the pressure on that asset class, on that type of tenant mix, is because of the cost of labor, right? So I think you're going to continue to see more automation coming into the retailers, right? So that they can, get their cost structure more competitive. The other big change in retail that we definitely have seen, is a lot of retailers that started as online only and have migrated into the physical brick and mortar retail. People say, oh, you're landlords, you guys are profit rent maximizers. And I tell them, you haven't seen anything until you've dealt with Google and Facebook and the online, right? The cost of customer capture, it continues to be very high online. And the ownership of that customer relationship, the retailers want that direct ownership, and they don't want somebody in between them. And they have that direct ownership when they can get to the owning a physical store. And there's been a lot of analysis and a lot of to prove that even their online presence accelerates when they build a physical store. So you see online, like Bonobos and Warby Parkers are classic examples where they've really migrated into the brick and mortar retail, and that physical store spurs their online sales as well. So that I think there's going to be this continued migration to omnichannel, right? Not just one focus. And the retailers that started off as strictly brick and mortar, they need to continue to migrate and to expand so that they've got their online presence as well. So it's an entire ecosystem that the retailers need to focus on. So and then the other big aspect of that is the ability for people to order online but pick up locally or return locally. And then I think the retailers find that when the customer comes in and wants to pick it up in person, that there's additional selling that takes place or opportunity for education that takes place when they get into the store. And we are, at the end of the day, we are social beings. We like to be together and we like that experience to get out of the house and walk around. And I don't think that changes over anytime soon. I think there's always going to be a place for physical retail, but it will constantly evolve.
Yeah, and that's super insightful what you shared regarding the omni-channel, aspects of retail, and that, the Warby Parkers, like you had mentioned, have established themselves more in a, physical retail setting for that exact reason, being top of mind. I read an article a while ago that referenced that impulse buys are, I think, 42% of all purchases. So the idea of being top of mind on a regular basis, that's why when you see all these online advertisements on your cell phone, they just keep popping up. And after a while, you're like, oh, you know what? Maybe I'll take a stab at it and buy it, But if you have the omni-channel where it's like, I see it on my phone online, and then I go into the store, and then they have these technologies now that can track where your phone's been, so they can, incorporate all that into the selling process. It becomes extremely powerful and impactful. So
and one of the things we do as a landlord that's maybe a little bit unique is we actually have a third party that we contract with. So any tenant that comes into our center, we don't need to do it necessarily for the nationals, but any of the smaller regional or independents, we actually go through and we do search engine optimization for them specifically at our center. So if you are at if you're in the city of Poway and you put in pizza near me, we make sure that our tenant in our center is optimized to come up first. So, we're trying to think through like what best practices can we bring as a landlord and use sort of the scale of our company's resources to help deliver best practices to all of our tenants. Because once again, nobody wants to see these tenants more successful than we want to see them, right? We want them to be successful. We want them to have great sales. We want them to renew. We don't want downtime on vacancy and releasing costs. So, a successful tenant is really, our end goal. And whatever we can do to achieve that, we're going to work on.
That's awesome. Great advice. So what we'll go ahead and do now is we'll open it up to Q&A. So for those of you guys who are on the Zoom call, feel free to type away in the chat box. Along with that, for those of you guys who are watching this live, feel free to type away as well, and we'll get your questions answered. In the meantime, Alex, do you have a insight that you wish, or maybe the question that I wish you wish I would have asked you that you think is kind of relevant to the topic of discussion?
Nothing that's jumped out of my head right off the bat.
No worries. Yeah,
but I mean, we could talk a little bit about the investment sales market right now, which has been kind of a very interesting period.
Oh yeah, and we'll jump to that right now. Jesse had a quick question. I'll go ahead and get his answered, and then we'll jump into that question shortly. So Jesse says, you mentioned that sometimes you will help the tenant by altering the lease terms. Do you ever offer social media help for better exposure as a way to increase their income? Seems like that can be a hurdle for some of the smaller businesses that don't have a dedicated marketing team. Would be a game changer for some of them if they could get help in this area.
Yeah. So one thing we do, like we talked about, the search engine optimization, right? So that helps. We definitely have, the property level website that we keep up to date. We make sure that, everybody's properly listed and all the hours are there. And then on top of that, we have social media. We typically use Facebook. So we'll build a Facebook page on the center as well. And then we'll really, work with the tenants and give them access so that they can be posting not only to their own Facebook, but then that can also feed to the property's Facebook page. But at the, so, we give them those tools. At the end of the day, we need the tenants to take responsibility and to grab those reins and move forward with it on their own. And the good tenants do it, right? The really good tenants are all over their social media, but we will bring in a consultant to the centers, and we'll talk to the independent tenants about what they could be doing to improve their social media presence. That was probably a more educational discussion 7-8 years ago, but now most tenants, they're right with us. They're there.
Great answer. So Alex has a question. He asks, his question is, I'm starting out and I'm in the position Alex was, being new to my industry in commercial lending. I'm calling commercial brokers and trying to help them find financing. We have aggressively competitive rates, but most of them see that I'm new and quickly lose interest. How do I convey to them that our lending rates are better than almost anyone you'll find? Interesting.
Yeah, I mean, I think it's promoting those successes, right? It's that establishment. One, I always tell our people, get out, make sure you're out of the office, right? Go to the industry event, especially if you're new. You want to make sure you're joining the industry association. So if you want to go after retail, it's ICSC, it's NAIOP, right? It's BOMA. You want to join the industry events where other people are at, and actually show up to them in person and make those personal connections. But then it's fostering that communication network that you've got to build, and it's promoting the deals that get done and the success of it. And it's a process, right, to build your reputation and to be out into the marketplace. So nothing. It's just repetitive. It's just being out and telling the story again and again and again.
Yeah, and then when I first started on the brokerage side, I mean, facing similar challenges as far as conveying the value you could provide as a newer broker or agent or whatever. I mean, leaning on the successes of people that are on your team is kind of a good way to start. I mean, you don't necessarily have the experience. Maybe you don't have the success to show for it, but maybe your team members do, or your leader in whatever company you're in does. So that could be a value to share as well. So that would be.
That's good advice.
Yeah. All right. So one question that we wanted to kind of touch on, as you had mentioned, was related to the investment sales landscape right now. I mean, we kind of are in an interesting landscape, to say the least. I mean, largest rate hike in the last, I think, ever that we've experienced. And so there is kind of a stagnation in transaction volume right now. I guess, how have you experienced the current, let's say, 12 to 18 month timeline?
Yeah. So I think one of the most important things is having a sense of patience in this industry, and in being able to say, hey, there's a period of time when maybe the best thing to do is not to do anything, right? And it's to sit out into the market and wait for a little bit better clarity, especially when you're in one of these very, very strong transitional periods where, like, what we've gone through has been unprecedented, the amount of interest rate hikes. And there's a high expectation that there will be adjustment, right? That will be caused by interest rates going up, right? And interest rates go up, obviously it puts pressure on the leveraged returns. We're in a leveraged industry. But the other thing it does is it cramps down availability of capital, right? And it's pretty clear that will have negative effects on value over some period of time if it stays long enough. It's always a waiting game, though, right? It's always, how long does it take before you really see the effects of these changes? When we came out of the 2008, the Great Recession, the buying opportunity did not, in the commercial real estate space, did not really start presenting itself until 2010, and 11 and 12. That's when the impact of this comes. And I think there's this, like if you're prone to being real active and wanting to get stuff done, the biggest thing you got to do is convince yourself that, don't go too quickly on this. Change takes a while to move through the system. It takes a while for any seller is going to want to sell at yesterday's prices, doesn't want to adjust. And there are times when there are just sort of flash issues in the marketplace, and maybe the sellers can wait through that period of time, and there is very little transaction that changes. And then there's other things when there's much more structural changes that come through. And my sense is you want to wait for it to really manifest itself versus going a little too quick. And it is so much easier to make money in this industry when you buy at a good value, right? Like there's this classic saying, the money is made on the buy side. And, we're a super long-term holder these days. So, we're not necessarily always trying to time it perfectly on, the bottom of to be able to buy. But it is clear that, it's very hard to recover from buying at the top of the market, especially if you're in a market that's distorted, like we were in this distortion with zero interest rates. Somebody once told me, sometimes when something grows like a weed, it turns out it was a weed. And I think that there was a lot of valuations over the last couple of years ago that were very weed-like, that were distorted just because, they were distorted because of the super low interest rates and the wild availability of capital. And, in the financial engineering that takes place when you get these distortions in interest rates. So having the other thing that I think is really important for the long term is if you're starting to get your return by a bunch of financial engineering, I think that's super dangerous, right? That is only going to work if you can get through that whole transaction within this window of time before you get a sort of a correction in the marketplace. And if your deal takes full leverage on the senior and a bunch of mezzanine and financing and a bunch of financial engineering to make it work, I would really think long and hard about can you get through that transaction before things sort of revert back to the mean? And once you get into any type of pullback into the capital markets, which we're in now, you're seeing like the effects of that, right? So the classic is, people that were out buying, multifamily with 2% interest only debt at full capitalization, right? Now they're having to roll that stuff over at 5.5%, 6% debt with amortization. And if they haven't had significant rent growth in that period of time, that's a real painful period to be in. So just, if you're engineering the returns, you got to know that you've got a unique bet going that you need to get all the way through that bet before things turn on you.
Absolutely. Couldn't agree more. I can't tell you how many different OMs I was reading for these different products, in particular multifamily, where these assumptions were outrageous. And they're assuming a entry cap of 7 and their exit is 4.5%, 5%. They're assuming from a 10-year hold period or whatever else. And the business plan that they formulated was, we're going to go in and renovate all these units and we're going to raise rents by 30 or 40%, which, for a period of time, I mean, I guess you could justify, but obviously in this environment, it's slowly shifting. So to your point, I'm interested to see what happens as more of this debt starts to mature, because a lot of these syndicators in particular, the ones who have been raising money to buy these larger assets that maybe aren't necessarily on the institutional level, they have notes that are coming due, like construction that notes that are turning perm, and I don't know what's going to happen.
Yeah, they're going to need some rescue capital. And the other thing is like that for anybody that's new in the industry, there's a world of difference from having your cap rate on if you bought at a 4 cap and having it reset to a 4.5 cap versus if you're buying an asset at a 6.5 cap and it's adjusting to a 7. That it's still only a 0.5 point increase, but that 0.5 point cap rate is an entirely different a different hit when you're at such a low cap rate. So you've got to be once cap rates get really compressed, and for us, as a been in this business for a long time, we just get to the point where we go, it's just time for us to put our pencils down and work on something else. We have enough other strategies going on where if things get really priced to perfection, like before the Ukraine war hit was a classic example, right? I mean, cap rates were at an all-time low, rents were at an all-time high, occupancies were all-time high, debt was an all-time cheap rate. And then when the Ukraine war hit, like we sat there and went, well, everything that's in the market is priced that everything remains perfect in the market, right? And not only remains perfect, but continues to get better. And there is this huge negative thing that's unfolding in Europe. And, we're like, I don't know exactly where that war goes, but I know that it will not improve any of these fact patterns of which things were priced at before. And, that's like a classic example for us where we go, let's put our pencils down. Let's stop looking at deals for a while and let's see what unfolds due to these big macro events. And I would tell people also that are new to the industry, the macro events do come down to the micro, right? They do impact big capital flows, impact your local deal. It may not impact it next week, but it is definitely going to impact it. So you get to an event where like Silicon Valley Bank blows up and First Republic, it takes a while before that really filters through all the other banks as an example, but that one actually filtered through pretty quick, right? Because the regulators realized that they had a risk that they hadn't really properly vetted, right? So it pretty quick went from those two banks failing to the regulators telling all the other regional banks, you're going to pull back, right? You're like, we're going to put the brakes on you guys. So keep an eye for the big events as well as what's going on in your local market.
Some great advice, really. So we're running close to the hour, so I want to be respectful of everyone's time. Wanted to say, first off, thank you so much for stopping by, Alex. We do greatly appreciate your time and all the insights you provided. I got a lot of from the discussion. I'm sure a lot of the people that were listening in did as well. And this will be available on YouTube and podcast format as well, so that we can listen to this in perpetuity. So if people wanted to learn more about projects you guys are working on, the different things that are related to the industry that you're providing, whether blog posts or any other things that you guys are pushing out on LinkedIn and other platforms, what's the best way for them to be able to reach out?
Yeah, you can just email us, get on our website and our information's on there. Feel free to call us or email whoever on our team. And we're always happy to talk to people. So, we're big networkers.
That's amazing. And you guys are affiliated in other organizations around the country. You mentioned ICSC, you mentioned a few other of these organizations. Do you guys regularly attend those types of events as well? I'm sure there's a lot of people on the call that are members, and I'm sure they'd love to connect at some point at future conferences and such.
Yeah. ULI, ICSC, NAIOP. Yeah.
That's amazing. Okay.
Hey,
and absolutely. And what we'll go ahead and do as well is we'll include all the links for your website, LinkedIn, everything in the show notes as well. So if you guys are watching this on YouTube, go ahead and in the description, you can access it. And if you guys are listening to this in Spotify or Apple Podcasts, again, you'll be able to access all that information down below. So Alex, thank you again so much for your time. We really do appreciate it. For those of you guys who are tuning in, we do this every other week. So we invite speakers to talk about a variety of different commercial real estate topics, continue to come back, continue to engage, and we look forward to seeing you all next time.
Great. All right. Take care, everybody.
See you guys.